Welcome back to the channel. The stock market today is crashing. There's really no other way to put it. A lot of stocks that have been kind of momentum names are down, a lot of them over 10% today. And I think this is something we really need to talk about because most people are confused about what's happening. And I think we've figured it out, okay? We're going to talk about it in this video. We're going to go over your broader market news and everything you need to know, where the markets are from a sentiment perspective. Am I buying this market? All of that. But I want to start with what I said to the trading community today. So I said at 10:59 a.m. this morning, when things really started to look nasty, I said, let me quickly share my thoughts on what I think is happening in the markets recently / today. Today, there's a slight rotation into staples. What does this suggest? Growth concerns, like staples. Johnson & Johnson was up today. A lot of other healthcare names, staple companies, right? Companies that aren't going anywhere anytime soon. This suggests growth concerns. Gold and silver selling off recently could signal growth concerns also. Momentum stocks suddenly selling off signals growth scare. Oil is below $60 a barrel, also suggesting growth concerns. 10-year treasuries below 4% equals growth concerns or low inflation concerns. Probably both. I said here, I think most of the growth scare at this point is coming from the government shutdown and fears this could lead into some kind of recession. Some people, including Treasury Secretary Besson, have said that the government shutdown could start costing the U.S. economy $15 billion per day. So logically, with a slowing labor market and this headwind, the longer the government shutdown lasts, the perceived higher the recession probability becomes. We are now on day 22 of the government shutdown, and basically all morning, that's all that has been talked about on CNBC. Like, for the most part, that's what they talked about like all day was the government shutdown. And, I think that's really what is starting to impact markets. Hassett said 2 days ago that he expects the government could reopen this week, but we'll see. We also have the China situation, but Trump has repeatedly said, quote, don't worry about China. I think Wall Street generally believes that. Now, are they a little, intimidated by that? Are they a little concerned about that? Probably. But I think generally Wall Street believes Trump when he says, don't worry about China. Now, what are the facts recently? Earnings have been great in aggregate. AI investment still seems to be alive and well despite the sell-off. We don't know what is happening with the economy besides earnings from banks and credit card companies that have told us the consumer is doing okay. There hasn't been any red flags from credit card companies. You would think that would be the first place you would actually see a lot of the problems arising if things were getting dramatically worse from here, okay? I know a lot of people that would max out their credit cards without a second thought if they had got laid off and they needed to pay their water bill or their light bill or whatever it is. They would max out that credit card and not think twice about it, okay? Especially if they have kids. So you're just not seeing a lot of that, okay? Capital One said things are fine. American Express said things are fine. So presumably the economy is still hanging in there, okay? I say here, while I don't know how bad this could get, I do know something definitively. If you believe a recession is coming next year, you should not be buying this market. If you believe the economy will avoid a recession, you should be buying. The real question is, are we buying a falling knife? The answer is recession or no recession. AI is alive and well. And as long as we don't have a recession, if we do have a recession, that's the excuse companies would use to slow AI investments. It's kind of one of those things where, maybe companies do want to slow down AI investments, but they're not going to slow down if nobody else is slowing down, because this is an existential crisis for a lot of companies. Google, as an example, their business model is under attack. They cannot slow down AI investments. But if there were to be some kind of recession and they all slow down, then Google could potentially justify that. Although I think that wouldn't make a lot of sense for most companies, which again, it's like, even if you did have kind of recession fears or a recessionary environment, slowing down on AI could cost your company big time, whether other people are or not, right? That could be Google's chance to get ahead, okay? Now, I say here, but from where I see it, companies are fighting for survival with AI domestically. Again, Google cannot stop AI investments even if they wanted to because their business model is under attack, and this goes for many other companies in varying sizes. We are also in an AI Cold War with China, so there's that. My thoughts. I understand why stocks have been panicking recently. We are in an economic blackout. Well, last we knew, the labor market was weakening, but I believe the economy is largely unchanged in recent weeks. I don't see a dramatic weakening. The restaurant I'm an operational 50% owner at is still hiring. Just hired 2 people today, and business is unchanged from prior months. I still believe the consumer has room to strengthen next year. Inflation will continue to come down in the next 12 months, and AI investments will continue. I see markets getting to a pretty fearful level. The comment section of YouTube has grown increasingly more and more bearish the last couple of days. To me, under the belief we will not have a recession is a buying indicator. That's why I did some buying today and will continue to keep buying until we have more definitive recession indicators. But that's the question. Recession or no recession? That's the real question right now. Now, if you guys want to come join the trading community, see the stocks that I'm actively buying, what I'm hedging, what I'm doing in my portfolio, check it out, link down below in the description of this video. We mainly target AI, energy, quantum. We have a quantum stock, biopharmas, gene editing, robotics companies. These are main themes for the next 10 years. We want to get in on smaller cap companies where Wall Street doesn't quite understand them. Wall Street understands NVIDIA to a T, but they don't understand Resolve, okay? Clearly, the valuation is reflective of that, okay? There's opportunities in the smaller companies where Wall Street has just not gotten around to understanding them yet, okay? So we're targeting a lot of those opportunities and exceeding and doing quite well. But again, let me know down below in the comment section, are you team recession or no recession? If you are team recession, you should not be buying a single thing in this market. Now, I'm not a financial advisor. I'm not a financial planner. Just as a general rule of thumb, like if we were to have a recession, stocks are going to fall a lot more from here. If we don't have a recession, logically speaking, you should see a recovery. Now, you do want to be a little selective in what you're buying, right? For an example, in quantum, there's one company I own, CCCX. They're merging into inflection, okay? The whole quantum space has been hot recently. I don't want to buy Rigetti or D-Wave or IONQ, but the significantly undervalued quantum stock relative to the other ones, that could be an opportunity if you believe in quantum. So you want to be a little bit selective in where you are deploying your capital. One that I've been buying a lot recently is UiPath, right? Path. It's a very well-known AI company at this point that just got deals with Snowflake and OpenAI and what's the other one? I believe Google, someone else. 3 major partnerships. Like, that stock goes on sale, I'm going to buy it because I don't think there's a recession coming. But if a recession comes, that's the risk. Now, with that said, let's get into more of your specific news today that helped cause some of this downside. Now, before we get to that, just take a look at the broader markets today. The Dow is down 0.25%. The Dow is still red, but there is a rotation again into some of your staple companies. Walmart, Johnson & Johnson, again, just to name a few, were some of the ones that did better today. S&P 500 was down 0.3%, NASDAQ down 0.75%. Russell 2000 really taking it on the chin here. Again, these are growth concerns. These are recession concerns. Down about 1.5%. The VIX is up 4%. So it's not like we're seeing a ton of fear out there, at least not suggestive in the VIX, but there is definitely some nervousness. Okay. Now, 10-year treasury yields are largely flat today, but they're below 4%, trading at 3.97%. Oil below $60 a barrel. It is up 2.5% today. I think mainly because the U.S. is going to be buying and restocking the strategic petroleum reserve. So that's important. Gold is down another 1.4%. And I think some people are a little nervous over that because you've seen quite a liquidation in the last 2 days for gold, where gold was just recently at $4,400 an ounce. Now it's down to $4,000. Looks like it might break below 4,000. Yes, gold has had quite a rally. Not super surprising to see a bit of a reset. But some of these issues, again, government shutdown, blackout from an economics perspective. We're not getting economic data right now. People don't really know where the economy is at. That is all coming together kind of as a perfect storm in October, where you do tend to have this seasonal volatility. October, while it is one of the best months of the year, October does tend to have the biggest swings. So October has the most 1% up and down days. Okay, a lot of people don't know that, but October is a very volatile month. It does tend to end good. Okay, it's the fourth best month historically out of the year, so it's in the higher, quartile of months, but it is a very volatile month, typically. Now, November is the best month of the year, tends to be pretty uniformly bullish, and December is the second best month of the year. So November, December, you're really heading into seasonal strength here. Now, Meta lays off 600 employees within their AI unit. Now, again, this is nothing. This is a nothing burger, okay? It's kind of like the news we got semi-recently, maybe a month or two ago, about Microsoft canceling some of their data center contracts, okay? People were like, oh my gosh, what does this mean for AI? Nothing. It literally meant nothing. They canceled some contracts, wanted to go somewhere else with those contracts. It means nothing. Meta's saying they're laying off these 600 employees basically because they want to be leaner, okay? They probably don't need as many employees as AI gets better and better. They can start letting go the underperforming employees, okay? I think this is pretty normal, and it doesn't signify anything. Now, also what you should be aware of is Friday, we're going to be getting the CPI report. Now, the sell-off in gold, the sell-off in risk assets actually suggests that we could have a really good CPI report. And I know some people are like, huh? How does that make any sense? Imagine if the CPI report was like negative 0.3% month over month, okay? You would think that would be good, okay? You would think that'd be great for stocks. But the reality is, if CPI were to, let's say, plummet, that is a pretty strong indicator that the economy is also plummeting. See, inflation and economic activity tend to go hand in hand, okay? If, for an example, you have high inflation, you tend to have strong economic growth. People are willing to pay more for products and services, so on and so forth. Inflation cannot thrive in a weak economy. So if inflation were to plummet, which, the plummet in gold and silver kind of suggests that, then that's a sign the economy is plummeting. The problem is we don't have economic data, okay? We just don't know. And there's, like a data blackout right now. So I think that's making some people a little nervous. Now, as I said in, I believe it was yesterday's video, it did look like the CPI report maybe got leaked to some of your big money. And that would make sense why, again, momentum stocks are selling off if we get a really good but alarming CPI report. Now, this, if that's what we get, if we get a low CPI report, that's going to prompt the Fed to be cutting rates more aggressively, of course, and maybe that offsets some of it. Maybe that, is a positive to offset what could be a negative. But until you get to Friday, you just don't really know. Now, here's the other part of it. Stocks are selling off aggressively recently, right? So maybe you're pricing in that really good, but could mean really bad CPI report for the economy. Maybe we get the CPI report on Friday and you actually see stocks do very well on it. That is also a possibility. It's kind of like if a stock sells off into earnings and it's not as bad as feared, the stock can go up even on bad earnings. Even if earnings are bad, we've seen that with Enphase a lot. The stock would just sell off aggressively, really low expectations for earnings. The stock would have bad earnings and it would still go up. Now we see it all the time with a stock like Tesla. Tesla might rally into earnings, give you basically everything you want to hear, but it's not impressive enough and the stock sells off. So that could happen on Friday. Friday could be the reversal day. Now, with that said, we do have earnings from Tesla in after hours today. IBM, Kinder Morgan, QuantumScape, SAP, Alcoa, and Lam Research. Tomorrow, American Airlines, Honeywell, Dow, Hasbro, Nokia, Southwest, AutoNation, and T-Mobile. Thursday, in after hours, you have Intel, Newmont, Alaska Airlines, Deckers, Boyd, Ford, and then Friday, you have P&G and some others. So basically, earnings, although they've been really good, you have the highest earnings expectations that you've had for a single quarter going back to 2021. Hence, partially why stocks did well over the last couple of months is because earnings estimates keep going higher. Some on Wall Street might be a little bit nervous as we get to big tech earnings, specifically again around AI investments, around, profitability metrics, when you're already expecting really good results, okay? So that could be part of the fear. If we take a look at the percent of stocks trading above their 50-day moving average, you're at 48.5%. So basically 52% of stocks are trading below their 50-day moving average. So there is, again, some pretty severe weakness out there internally in markets. The CNN Fear and Greed Index is sitting at 27. You're almost back into extreme fear. Market momentum is fear. Stock price strength is fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatility is neutral. Safe haven demand, extreme fear. And junk bond demand currently in extreme fear as well. And again, the AI Investor Sentiment Survey showed bullish investors at 33.7%, bearish investors at 20.3%, and neutral investors at 46.1%. We will be getting a new AI investor sentiment survey tomorrow. I think the bears are probably going to go up again. The bears could cross above 50%. And again, with these kind of sentiment indicators, as long as we don't have a recession, historically, you will do very well if you are buying the dip. If we have a recession, none of this shit matters because stocks are going to fall a lot more. Now, I am under, again, the prevailing narrative that inflation is going to continue to come down. The Fed is cutting rates. That's going to be stimulative for the housing market. We've already seen some pretty good housing numbers starting to come out. But you have to remember, 50% of households are a little bit more than that, are homeowners. And they have a lot of equity. Okay, there's 4 million homes sold a month on average in this country. People are going to be able to take, 100,000, 200, 300,000, whatever the number is, to their bank accounts after they sell their home. What are they going to do with that? They're going to invest that money or they're going to spend that money. That's just how America operates. So there's going to be a boost to consumers from the housing market alone. Not to mention the big beautiful bill, no tax on tips, no tax on overtime, being able to write off things like auto loan interest, so on and so forth. So I think those things help the consumer. I think inflation continues to come down. You have rate cuts. You should be a pro-growth administration, cutting red tape. We'll have to see. That could take a little bit of time to play out, but maybe at some point next year we start to see the benefits of that. And I believe AI is alive and well. That's the bottom line. Companies internally are fiercely competing with each other. They cannot afford to slow down on AI, right? OpenAI doesn't want to slow down because then they're potentially going to give the lead to Google, right? Google doesn't want to slow down because then they're just going to let OpenAI win, okay? Those are easy examples, but the competition is happening with all these companies, and that's on a micro level. Then on a macro level, if you're looking at the globe, you're competing, all of America is competing with China. Okay. That's not going away anytime soon. So, when I put these things together, kind of like Mike Wilson said last night, following the Doge layoffs, he actually thinks we're heading into a new economic cycle, that the old economic cycle, the rolling recessions, the labor market weakness is actually broadly over, and we're heading into a new economic cycle. Okay. That's very early. So with that as my expectation, I think it's an opportunity to be buying stocks right now. And I know it looks ugly. It's scary if you look at your portfolio and you're down thousands of dollars or tens of thousands of dollars. And it's supposed to be that way, right? Again, I think you want to be selective in, again, if you have 10 stocks you like, but 5 of them are overvalued as hell, that are pure momentum, pure speculative. Maybe they don't have revenue. They don't have a clear business model. Like, I would stay away from those, even in this environment. If you have 5 other stocks that are undervalued or reasonably valued, that are bringing in revenue, that are growing quickly, that are in a market that has a lot of growth, that is where I see the opportunity at this point. U.S. House Speaker Johnson says Democrats are eating up the clock and it gets more difficult by the hour to get appropriations bills done on time. Johnson says we're running out of time to do the necessary things. Now, Korea aims to finalize the trade deal with the U.S. during APEC. Trade Representative Greer says Trump and Xi have a great relationship. Bank of America's clients are back to selling stocks after buying the dip. Bank of America Securities said clients resumed selling U.S. stocks last week after briefly, quote, buying the dip, led by institutional and hedge fund outflows. Despite a 1.7% gain in the S&P 500, $2.1 billion in single stock outflows outweighed $1.2 billion of ETF inflows. Institutions who were big buyers the week before became the largest sellers. While hedge funds extended their selling streak to 6 weeks, retail investors kept buying, focusing on mid-cap stocks. Greer on China trade and rare earths says that they have other deals coming up with other countries. Greer on China trade says there is a good landing zone where we can be more balanced. So basically, I mean, the headlines today don't sound terrible. Like, you can't justify the sell-off in markets from the headlines, and that's why it sounds like, or seems like to me, this is more of a government shutdown, growth fear related decline in markets. And that's what really brings up the main question. Do you think we're going into a recession? If you do, I'll say this. If I thought we were heading into a recession, I would not be buying any stocks right now. I do not think we are heading into a recession. I think the fear at this point is growing out of control, which is a buying opportunity. And that's why I've been buying, but I have been selective in what I'm buying. Buying the highest conviction stocks, the stocks where maybe they're a little bit more established, maybe they have revenues, or they're slightly profitable, or, something like that. Maybe Wall Street is ignoring good news. Okay, those are the kind of opportunities that I am targeting right now. Again, if you guys want to come see the stocks that we are actively buying in the trading community and potentially hedge a portfolio or two if markets continue to fall, check that link out down below in the description of today's episode. But with that said, ladies and gentlemen, that is it. Have a great rest of your day, and I will see you in the next one.